Hey there, everyone. Happy Wednesday, January 22nd. Welcome to Chart This with Dave Keller. I am your host, Dave Keller, coming to you from a pretty cold, but I don't want to brag because I feel like we're all feeling the cold right now. I feel like we have it better than others, but a pretty frigid, but still clear and fairly sunny Redmond, Washington. Hope you guys are doing well and staying warm wherever you're at. Speaking of heat, the heat generated from the continued bull market continues to warm investors. We have the S&P threatening new all-time highs today, just barely pushing above that 6,100 level, though it closed just barely below there. Again, we're seeing renewed strength in the market. Our market trend model remaining bullish on all three timeframes as of last Friday, and we're continuing to see growth lead. What's interesting is, and this is one of those days where I would argue it's really helpful to look a level down, right? And we think about sort of second level analysis, right? That top level, what did the S&P do? What did the NASDAQ do? Maybe what did small caps do? But then the next layer down is looking at sector movements, looking at the types of stocks leading to the upside and the downside. What you'll notice is that most sectors are actually down today. Most stocks actually closed down today. Was not as strong as the major averages would indicate. However, the Netflixes of the world are providing plenty of juice to the upside. We're seeing more 52-week highs than we've observed so far in the early days of 2025. So a lot of reasons to be fairly optimistic. With that in mind, let's look at the charts and how they played out today. As a reminder, I can see questions that you put in. I appreciate you, those of you that are tuning in live. I can see your questions on any platforms we're streaming on: Facebook, LinkedIn, YouTube, and X. Thanks so much for watching me on any of those platforms. Anywhere where you can enter a comment on one of those platforms, put your questions there. I can see them as we live stream, and I'd love to take a question or two at the end of the show before we wrap the live stream for the evening. If you're watching this as a replay on our YouTube channel, I appreciate you as well. Just put a question in the comment section. We're planning an all mailbag episode Friday of this week, and we'd love to answer one of your questions on the air. All right, looking at the major averages today, we can see, again, decent update. And at the high level, top level, looks pretty good. And to be clear, it is, right? The most bullish thing the market can do is go up. Famous market practitioner and technical analyst Paul Montgomery wrote that years ago in his longtime market letter called Universal Economics. Indeed, the market going higher today. The S&P, again, traded above 6,100, almost like to the penny, right to that level. Pulled back a little bit, but closed at 60.86. So again, we're literally at new all-time highs today. The NASDAQ Composite leading the way higher, up 1.3%. The Dow finished in the green as well, about 1/3% higher, just about 44,000. Mid caps and small caps, this is where things start to become a little more clear. Small caps down to 0.8%, mid caps down 0.4%. So the smaller the name, probably the worst performance. Now, if you look at the sectors that led today, they're not very well represented in the small cap space. Small cap tilts a little more value, a little more to sectors like industrials, materials, financials. These were sectors that did not lead today and actually were not in the green. The VIX basically treaded water today, held right around the 15 level. So again, VIX in the mid-teens means low volatility, low fear, low uncertainty. Looking at the bond markets, rates pushed a bit higher today. So the market moving higher on essentially on higher rates. The 10-year yield ended around 4.6%. The long bond just above 4.8%. And the 5-year yield around 4.4, just slightly above there. So we have that normal shaped yield curve as we've covered. And if you've listened to some of my recent interviews on the Market Misbehavior podcast, my interview with Sam Stovall last week, we talked about a sort of a did you know segment, I guess, looking at returns after things like the yield curve becoming normal shaped, after the first rate cut. And the reality is, in the next 3 to 6 months, things are not particularly consistently strong. The market actually struggles after those things happen, which is what we saw, what basically happened at the end of last year, fourth quarter, and so not surprising that we have a period of choppiness here at the first half of 2025. The longer term, right, a year out and further, things tend to be quite good, and so that's, I think going to be the story of 2025. If I had a crystal ball, and I don't, I wish I did. But if I did, I'm guessing it's going to be one of those choppy digestion years as we deal with the normal uncertainty that happens after an inverted yield curve becomes more normal. after that first rate cut, which we experienced last year, and what tends to happen afterwards. So bond prices moving slightly lower. The TLT was down about 0.5%. The dollar, no real change from yesterday. We've tracked that stronger dollar environment. Yesterday was down. Today sort of holding steady, but stronger dollar, I would argue, still one of the biggest risks, especially on a day like today where you see mega cap growth kind of leading the market higher. What concerns me is those are all companies that make a lot of money outside the U.S. The stronger the U.S. dollar, and certainly if the dollar continues to strengthen from here, those non-U.S. revenues, just the math works out that they're not as valuable. And so their non-U.S. revenues are just less of a help to beating their earnings numbers. And so that is a potential headwind for sure. Looking at the commodity space, the broad commodity ETF that we track, the DBC, essentially flat for the day. You can see gold moving higher by about 0.5%. The GLD closing just above 254. Silver prices basically flat. Crude oil prices continuing lower. So one of the big sort of new policy unveilings, I guess, from the new administration, the Trump administration, talking about drill, baby, drill was the direct quote from the presidential address on Monday. So really implying, most likely that moves energy prices down pretty good as you increase supply. And we're certainly seeing that. The USO down another 0.8% today. Energy looked like a really decent bet as crude oil aiming to $80 a barrel and potentially pushing above there, with crude oil feeling the pain after announcements earlier this week. Certainly seems like a time to wait and see where we get some stability from crude oil prices. Bitcoin did trade up to around 107,000. This is after bouncing down to around 100,000 over the last 24, 48 hours. We've retraced back up to around 107, currently trading right around 104. Again, big lines in the sand, big round numbers tend to matter for Bitcoin. If you look at the chart of Bitcoin and draw horizontal lines at 10,000, 20,000, 50,000, 70,000, those big round numbers, you will find more often than not, you tend to find rotation around those points, what we would call in the technical analysis vernacular, a pivot point, right? A level that has meaning, a support and resistance, and big round numbers tend to matter. So again, I think for now, Bitcoin holding 100,000 is pretty meaningful, and we'll see if we can build momentum to further highs. Most of the top 10 coins actually in the red today slightly exceed Bitcoin and Ethereum, trending lower through the course of the equity trading session for sure. Looking at the 11 S&P sectors, this is what I mentioned in the introduction. At the high level, indexes going higher, that feels good. The problem is when you go a level lower, you can see this was pretty much all technology and communication services. Tech, the XLK was up 2.25%. Communication services, the XLC, up 1%. And that is it. The number is 2 of sectors actually closing higher today. The other 9 were down. That is not a warm and fuzzy bull market kind of day. That is more of a things are not as good as they sort of look. You have a very small number of sectors that, of course, have a huge weight. These are big mega cap companies that dominate these indexes or these particular ETFs. This is the Apple, Microsoft, NVIDIA, semiconductor, and communication services, Alphabet, Meta types of stocks that are doing quite well. As a result, major benchmarks can go higher. And that's how the indexes can be in the green when most of the sectors were actually down. On the downside, utilities down 2.2%. Energy, moving lower in I guess, complement to crude oil prices rotating lower, down about 1.8%, about the same for real estate and so forth. So overall, again, in terms of sector breadth, not great. In terms of individual stock breadth, also not great. And that's another issue I'm seeing here on a day like today. Advancers, decliners, very much favoring decliners over advancers, about a 2-to-1 ratio. Looking at the S&P 500, it's about 66% of the S&P names down, about 34% positive. So 2 stocks down for every 1 that was positive. Breadth was negative for all the major U.S. indexes, most significantly for small caps. And as we've mentioned many times, small cap indexes have a very different construction than large caps. It's not just the same index, but just smaller companies. It's a very different index. And I know that just from time at Fidelity, working with portfolio managers and having members of my team deeply analyze the small cap, mid cap, large cap, growth, value indexes, just to think about how they were weighted and how they were constructed. Small caps a lot more into value sectors like industrials, healthcare, financials, materials, kind of things have a much bigger weight. Growthy sectors like tech, communication services, consumer discretionary, a smaller percentage. And as a result, day like today, value sectors not doing as well. Small caps are going to be hurting on a relative basis for sure. Our market trend model, as we mentioned on the show yesterday, back to all green. This is after today's close. Again, a Friday at the close is when I formally update the model, which I did last Friday. And certainly market trend model now rotating back bullish on all time frames for all major U.S. indexes. You know, again, I was taught the most bullish thing the market can do is go up. I was taught don't fight the trend, or don't fight the tape, I guess is another way to say that. And the tape is positive in terms of the trend of the major averages. Now, days like today, I immediately think, all right, what sort of weakness was not reflected in the price of the S&P and the NASDAQ, but maybe there? And I would say the weaker breadth, the lack of sector support, the fact that this was narrow leadership, all suggests limited upside until you get more improvement in other areas of the market. Looking at the Magnificent Seven and Friends, sort of the mega cap growth trade, you can see Netflix, of course, with blowout earnings yesterday. We talked about the technical setup going into earnings. We looked at the after-hours session, which was up big, certainly opened higher, and interestingly enough, actually traded lower through the course of the day. We'll look at that chart in our chart review portion. But at the end of the day, up almost 10% from close to close. So a nice upside move for Netflix on strong subscriber numbers. And again, it's the whole sort of growth space bull market, I feel like, was encapsulated with Netflix streaming subscribers, being able to raise prices, all of those things helping the stock go higher. NVIDIA up 4.4%, Microsoft up over 4% as well. So NVIDIA and Microsoft, two of the three big weights in the XLK. Apple would be the third. Apple was up slightly, but those two, NVIDIA and Microsoft, both being up 4% plus, certainly is going to help the S&P and the NASDAQ go higher. Note at the bottom, and someone mentioned in the comments section on our YouTube channel, Tesla down. We've highlighted how there are some outliers, right? And when you have a group of stocks like this, these are not the same company, right? They're very different companies that are represented in these 8 stocks, right? All in the growth sectors, all in the growth space. But not a significant, but not, I guess, homogeneous, I guess, homogeneous, I guess is the way we would, not all the same, right? There's some differences here. Look at how Tesla is down about 2%. Apple, as we've documented on the show, very much an outlier in terms of a consistent downtrend from December to January with no real bounces. Today is one of the few days you've actually bounced a bit higher during this downtrend phase. We have a couple of those charts that I grabbed to review in a little more detail as we get to the chart review portion. As a reminder, I can't see some of the questions coming in. I appreciate it so much. Keep them coming. We'll get to a question or two before the end of the show. Those we don't get to, we'll put in the mailbag. We'll do an all mailbag episode at the end of the week, and we'd love to feature one of your questions on the air. All right, looking at the heat map, the market carpet, which is a heat map style visualization. I love things like this that allow you to go macro to micro, go broad and more specific, help you understand how different stock movements relate to the overall indexes. Big thumbs up to these types of visualizations. I would encourage you to explore these sorts of things in your own work. Over my career, I've leaned into these more and more over time, and have very much appreciated the color and the depth that you get from this sort of visualization. Immediately I'm drawn to the bright green in the upper left and the bright red in the lower right. Let's talk about each of those separately. In the upper left, you have the two big dogs, NVIDIA and Microsoft, both in the green, both up over 4% today. Significant up move for those two leading technology stocks, along with Apple. They represent probably 40 to 50% of the XLK. I should know that off the top of my head. I'll look it up for the next episode, but it's pretty big. And so those stocks, how those stocks go, the rest of the sector is certainly going to feel as if it goes as well. So those are two leading names showing renewed strength. I would also point out, though, there's a lot of other things actually doing quite well. What's not doing well are renewable energy names, understandably so, right? I mean, one of the big sort of rotations in policy from a Biden presidency to a Trump presidency is leaning away from green energy, clean energy, new energy, renewable energy, whatever you want to call it. So the S&P components in that space, First Solar, Enphase, Solar Edge, all in the red. I think that's just the beginning of those stocks feeling quite a bit of pain. These are names that certainly had a huge tailwind with a progressive policy decisions, a lot of investment, and a lot of propelling those stocks and those companies higher with rebates for consumers. All of that kind of going away. And so you're seeing those in the red. I am feeling pretty good about getting the Tesla before all of those policy changes. So that worked out pretty well timing wise, but we digress. Elsewhere, I would say, again, a number of other technology names that were not the biggest names, but had quite strong days. Look at Oracle, Arista, Amphenol, APH, Cadence, CDNS, Synopsys, Empower, one of the semiconductor names, having pretty good days. So again, Seagate, also an earnings name this week. So plenty to like in the technology space. Again, outside of the renewable energy, which we on stock charts have grouped with technology. Now, the counterbalance to that, and this is the problem, right? If you sort of literally physically cover up the left third of your monitor and look at the other right two, you can see that there's a lot of red to be had, more red than green. Look at real estate and utilities. Now that on its own seems kind of bad. No, these are fairly defensive sectors, so they're getting dinged pretty good. These are more defensive areas of the market that you would probably see more outperforming if investors were getting nervous, if investors were getting cautious, and institutions were rotating to more defensive positioning. Mixed results for things like energy, honestly, more clearly lower, but within materials, within consumer staples, a little more neutral, but more negative than positive. And really outside of this, it's a very modeled appearance. I think the strength is in the left third, which is technology and comm services. Two of the biggest sectors, two of the biggest weights, and where you're seeing quite a bit of strength today. The rest of the market does not look particularly good. Now, that should be concerning, I think, from a breadth perspective, right? Because healthy bull markets tend to see an expansion in breadth. They tend to see improving breadth. You need more stocks making new 52-week highs, which we generally have seen so far in the last week. You need advanced decline lines rotating higher. You need stocks having bullish breakouts on their point and figure charts. You need stocks back above moving averages. All of those things can be measured through breadth indicators. And so I would say a day like today makes me feel like the breadth is probably not improving. And that's not what you want to see, right? For, the market can rally with narrow leadership like NVIDIA and Microsoft, but a sustained rally with real upside potential, I think, has to be driven by, not just the generals, but the infantry moving higher as well. And that's where you did not get that on a day like today. Again, breadth has improved over the last week, to be clear, but today very much not so. So certainly a theme to observe through the remainder of this week, particularly as we're going through the meat of earnings season. And it's a lot of non-growth sectors that are reporting earnings this week into next week as well. Ooh, I think that's probably it. Let's get to the charts, shall we? Looking at the charts, and someone mentioned being on the Fidelity webinar earlier today. Really enjoyed talking with Andrew McGovern on the Fidelity webinar. We had a great discussion about just investing and technical analysis and some of the key things that I've learned and best practices, and hit on some of the points that we cover on the show. So if you joined me over there, I'm glad you did. A big fan of Andrew and his team, who do a ton to educate Fidelity clients and Fidelity active trader users on how to use technical analysis. And for that, I am a big fan of educating and empowering investors to make better decisions. I think technical analysis is one of the best ways to do that. So thanks to those of you that are mentioning that you caught me over at the Fidelity webcast. I appreciate it. Let's look at the daily chart of the S&P 500. We can see, just narrowly making a new all-time high today on a closing basis. We're kind of right there. It might have technically done so. But I would say from a general technical perspective, 6,100 is the high. We traded above there, but didn't close above there. Think of it as an if-then statement. I think if the S&P goes above 6,100 going into next week, what do? Well, number one, hopefully you're following that trend higher. And as we've talked about, our market trend model is back to bullish on all time frames. The break above this pink trend line tells me that we're, at least in the short term, definitely moving higher. I want to participate in that as long as possible. So while I will tell you there are a lot of reasons why the market should not be going higher, concerning developments that we've observed from the Hindenburg moment on, In the short term, we're not seeing that. We're seeing strength. So if number one, I would say follow the trend, follow the tape, don't fight the tape. If it goes higher, we want to follow it. The other thing I would say, and this is a potential scenario going through the remainder of January, maybe into February, what if the S&P makes a new all-time high, which again, it essentially did today, almost did it on a closing basis. What if we start pushing above 6,100, but on weaker momentum? So the RSI actually doesn't make it back to the overbought region. What often happens, on a last ditch effort to make new highs, is you see stronger price action on weaker momentum, right? So higher highs in price, lower highs in momentum in the RSI. That would be what's called a bearish momentum divergence. Major market tops are usually punctuated by that particular divergence pattern. So something to maybe think about if we, in a chart like this, when we do make new highs, I immediately glance down to the momentum to see if it supports it, because this is just looking at the pure price action. This is actually measuring the up and down days and the relationship between those, the strength of the up days versus the weakness implied by the down days. And if you see a higher price movement on weaker RSI, that basically means there's more distribution than embedded in the price action of the S&P, is what that basically implies. Now, we can also look underneath the hood, as I like to say, and look at breadth indicators. Today, as the closing price data is updated, you can see some of these have updated for today's close just yet. Some of these have not. These are the cumulative advanced decline lines for the New York Stock Exchange for large caps, mid caps, and small caps. Overall, you can see that all four of these, as of yesterday's close, have closed above their 50-day moving average. We'll see if today's small cap breadth goes slightly below it. But as these have pushed back above their 50-day moving average, I've color-coded them neutral orange. I would color-code them bullish green if the advanced decline lines make new highs. So that's another thing to think about as the S&P, and NASDAQ, if they would continue on and make new all-time highs. Do you see those new all-time highs confirmed by these advanced decline lines breaking out? And if not, that could be a red flag as well. Basically, the market moving higher on weaker breadth usually is not a sustained move. Now, the McClellan oscillator, which is one of those components in the Hindenburg Omen, as we covered very deeply in the month of December, the McClellan oscillator is one of those components. Pushed back positive. It went slightly positive right at the beginning of the year, and then about a week ago, at the beginning of actually toward the end of last week, pushed above the zero level. So the McClellan oscillator is back positive, which means short-term breadth is constructive. This is one of those indicators where you often see divergences at short-term peaks. Another thing to watch. So again, as the market drifts higher, I'm always looking for signs to be concerned about, right? What is telling me that we're maybe near the end? What is telling me, anticipating that we're at a potential peak? The McClellan oscillator for now, nothing but positive, I would say, at this point, being above zero, no divergences or anything yet. That's something we might look for going forward. But for now, clearly pretty positive. The high yield option adjusted spread. This is an indicator with a bit of a lag because it's reported at the end of the day and then picked up later by stock charts. But this is basically a measure of credit spreads, which is a common way to sort of measure the risk appetite or the risk assessment by bond investors. These are basically spreads on corporate bonds of junk bonds of risky companies, or high yield bonds as they're called, and basically the spread above a risk-free rate where these things are trading. You'll notice, and this is plotted upside down just to more match the trend in the S&P, which is in the bottom. So plotted upside down, we can see spreads have been narrowing. These values have been getting lower and lower. And what those narrower spreads mean is basically the bond market is not seeing a lot of risk right now. They're seeing kind of a risk-on, things are good environment, seeing a low likelihood of risky companies being unable to repay their debt obligations in the form of coupon payments if you own their bonds. So they're saying things are pretty good. This chart is one that's in my market misbehavior live chart list, because I have found that when these things start to rotate lower, you really want to get out of the way. And that's why we saw that in July and August, which is when we, certainly, leaned away from the market. You can see that in November into December, where the spreads widened out, the volatility increased as the VIX popped higher, and those coincided with stocks having a bit of a pullback. For now, spreads are narrowing. Volatility is remaining very low. These are bullish configurations for those particular indicators. Let's look at a bunch of individual stocks here. We're now in the meat of earnings season, and we never have enough time to go through all the charts that I would like to highlight. So I'm just highlighting some representative names that I think are worth paying attention to, and I would encourage you to ask questions about other tickers that I don't get to. See if we can make some time to do so. So the good news for Netflix is we made a new all-time high. The other good news for Netflix, we hit $1,000 a share, which is, arguably the big round number, the ultimate big round number for a lot of stocks. All those things are good. The momentum is improving with the RSI pushing above 60 today. Here's the bad news. We were up to 1,000. We closed around 950. So after hitting 1,000, we dropped about 50 points. So not an end of the world kind of move, but that's a pretty big drop after being up a lot more in the after hour session, after being a lot higher at the open. We opened high but closed lower. So, when you have a gap like this, you want to look at how that gap plays out and what happens sort of post gap, right? And so the initial gap higher seems pretty bullish and certainly is nothing but that. But what happened afterwards was very distributive, right? So you had lower trading through the course of the day. We closed near the lows of the day. So that tells me that a lot of people were thrilled to cash out at Netflix at $1,000 share, even at 960 or 970. We're thrilled to just unwind and get out at a 52-week high. There weren't a bunch of people buying into Netflix on that gap higher. It was pretty much all selling through the course of the day. So that does not make me feel good about the sustainability of that breakout. It's sort of like, yay, we broke out, but boo, we kind of closed near the lows. Something certainly to watch going into tomorrow's session. Do you see buyers coming in now that we are able to sleep on earnings another night? Do you see people coming in and buying at 950 and thrilled to retest 1,000? And if not, this feels like a concerning breakout. Also a potential divergence here. If we would rotate lower and see the momentum stall out here, that would make that bearish momentum divergence that we talked about could be an issue for things like the S&P. Amazon as well, making a new 52-week high today, making a new all-time high today, pushing above 235. That's bullish. Problem is the momentum is not quite matching the breakout just yet. So you have higher price highs on weaker momentum for now. Now it's still an active trend. We don't know where this trend is going to end. If it continues to 250 and the RSI goes all the way up to 80, it's not a divergence anymore. So it's worth waiting to see where this secondary peak might end up and what sort of momentum we see there. But for now, price is breaking out, and that's bullish, right, on the surface. Alphabet, not quite breaking out, right? So while Netflix making a new high, while Amazon making a new high, Alphabet has been attempting to do so this week, but has been unable to get above 200 and hold it. We actually traded above $200 a share back here third week in December. We also traded above it first weekend of trading of this year. And now over this week, we have traded above 200 a couple times, but have closed near the lows of the day. So this more and more feels like Alphabet confirming $200 a share as a really important resistance level. I think this is a great chart if and when we can get a foothold above 200. I think it's a good chart unless we can do that. And I think it's an ugly chart if we start to break below 185, which means there's plenty of room, 15 points or so for this stock to sort of chop around. But I think a break above 200 is what you need to see, ideally on stronger momentum, on stronger volume. That's what we've not seen just yet. A lot of financials reported last week, sort of as we kicked off Q4 earnings season. Capital One actually reported yesterday, though, and you can see it was a pretty good earnings report. Financial sector, really good earnings. And while a lot of those names are down today, Capital One is one of those that is not. They actually reported earnings yesterday after the close, up another 4% today, trading to $200 a share. A lot of round numbers coming out right about now, but I would say overall this is a strong chart. Short-term support at 175, so you got about 25 points of room back to that previous swing low. The 50 days around 185, but I like the breakout above 195, which clears that resistance from around Thanksgiving. Strong chart. DR Horton actually reported, and you can see it's not really a bearish engulfing pattern. I think we highlighted this on the show yesterday. It's not a bearish engulfing pattern because that would have to be an up day followed by a down day. But it is what's called a bearish outside day, which is more of a bar chart technique where you have wider range, open to high to low range, that is, and a lower close on day two. And so we did get a bit of distribution today, bouncing higher, not quite getting 50% of the way up through the candle, which means it's not, what is that one? The bullish piercing line, that's called. had to dig into the Dave Keller candle pattern library somewhere in my head. Bullish piercing line would be a 2-day pattern where day 2 opens lower, closes at least 50% of the way through. It didn't quite do that. So the fact that it didn't quite get to halfway through yesterday's candle implies it's not a really bullish candle pattern just yet. The momentum is pretty much neutral, right, with the RSI right around 50. So I would argue this is a chart that needs to get above the 50-day to be considered for a nice potential ride higher. For now, still some to be proven. Stock that has broken above the 50-day and has broken above short-term resistance, Monolithic Power Systems. MPWR is one of the semiconductor names that is not NVIDIA and AMD. It's one of those other ones. I would say this is a stock that's been sideways, and not surprisingly, the SMH, the SOX have been sideways as well, kind of range-bound charts. We're starting to see an improvement in the semiconductor names overall, certainly over the last week. Today, MPWR closing up another 8%. That has we've already cleared the 50-day. Now we're breaking above resistance around 650. We got up to $700 a share today, but I think what's most encouraging is the fact that the momentum is improving. So a chart like this that has now established a new low, a higher low around 575, and powering above moving average resistance, powering above the swing highs. That's a good chart with likelihood to push ever higher. So nice breakout, and in the semiconductor space. Another couple names here to talk about, and then I'll take a question or two to finish off the live stream today. UAL reported earnings yesterday. Is that true? I might be making that up. Let's confirm that. Oh, I can do it right here. UAL. Yeah, yes. I was going to say, I thought that was yesterday after the close. I did want to highlight here the bearish engulfing pattern, right? So a candle pattern, we have an up day, a down day. Day 1's an up day. Day 2's a down day. The real body, the open to close range of day 2 engulfs the range of day 1. That's the bearish engulfing pattern. Bearish because it's down, engulfing because it engulfs the previous day's range. That's a 2-bar or 2-candle pattern that suggests short-term weakness. Now, the 50-day moving average is around 98. We had a hammer candle, which you'd probably call a dragonfly doji. We're going deep into candles today for some reason, but that's where you have the open and close right around the same level, a long lower shadow. Look how it dinged the 50-day moving average before bouncing higher. Maybe that's the downside objective after this distribution pattern. Also note, as we've made new highs in January, the momentum has gone weaker. This is the RSI overbought here in October, November, early December, not overbought this month. As we've made new highs, that's a divergence. It's a bearish candle pattern. I think UAL most likely heading lower based on that particular combination of indicators. 3 stocks to finish off. These are actually companies reporting after the close today. We don't have time to go through them. Some of them, actually, I think all of them are reporting after the close today here. LVS, Las Vegas Sands, making a new swing low here this week, 3% to the downside. What's concerning me about Las Vegas Sands is it broke to a new swing low, retesting the 200-day moving average, now trading lower. The moving averages are sloping down. The prices at the bottom were oversold, but you really need something like earnings to provide some sort of upside momentum. From a trend perspective, it's a pretty negative chart. Note the divergence there in December when we made new price highs on weaker momentum. That's the danger for some of those other charts, as we mentioned. Steel Dynamics, STLD, is a materials name reporting earnings today. And I would say the concern here is this week we have tested the 200-day moving average today, pulling back off of that 200-day. With earnings, you'd want to obviously see an upside reaction, but getting above the 200-day from a technical perspective, I think completes that bit of a recovery off of the swing low at the beginning of the year. Would love to see that. And if so, potentially we retest the previous highs. Textron, another one reporting after the close today in the aerospace group. Industrials, one of the better sectors so far in 2025. Early days, of course, but this week testing the 50-day moving average from below, pulling back. We're below 2 downward sloping moving averages. That would have to change. The RSI stalled out at 60. That would have to change. A chart like this, I look for the 1-2 punch of back above the 50-day on improved momentum. To be seen, right? TBD. Not getting that pattern just yet, but that's what I'd be looking for on the chart of Textron. All right, questions. And boy, you're so right. 3P investor, you're not wrong. You're talking more about the candle patterns because someone earlier asked you why all your charts are bar charts. You're not wrong at all. I'm not kidding you. I'm not kidding you. And again, I had a lot of fun with that interview. I think Andrew did a great job asking some really thoughtful questions. And a fair point. I kind of, came out of the Zoom webinar. I'm like, really, and this is what happens when I talk to someone who, looks at a lot of candle patterns. I'm like, why don't I use those more? I should. And I normally do. I just don't normally think to bring those up. I do occasionally, but certainly that inspired me to do so. And I would say, honestly, that's one of the great things about investing as a profession, as a hobby, as something that, that is challenging but rewarding, hopefully all wrapped into one. I love having conversations with others in the industry. I love talking with someone like Andrew, whose questions really, help you see how he has come through the industry and what he deals with day to day. Talking with someone who's more of a short-term trader. I interviewed Nishant Pant, who was my latest episode of the Market Misbehavior podcast. He's an options trader. We're talking about bull call spreads, vertical spreads, and calendar spreads, and different ways to structure trades in the options market. I don't think about options that much. And so after talking with him, I'm like, boy, why don't I use Bollinger Bands and Keltner channels and the TTM squeeze more often? I get it. It makes sense. And conversations like that make you dig into different charts or different indicators in a different way. And I think that's super valuable. So you were not wrong. That's certainly, as I was prepping for the show, that was probably fresh in my mind for a while. Titus Ryder, thanks for watching on YouTube. You said, since all the advanced decline lines are above their 50-day moving average, doesn't that confirm we should remain bullish? I mean, it's certainly one indicator, and thanks for watching, as always. It's one indicator among many. Is it more bullish than bearish? Certainly. I would say generally when those things are above their 50-day moving averages, that's much better than below. Generally, given the fact that we're sort of in a choppy transition kind of phase, these making new highs is what would be the bullish confirmation for me. Until then, I would think of it as more neutral. The way that I sort of loosely do it is it's making new highs, it's bullish. If it's bullish and then breaks below the 50-day, that's then neutral. Makes a new swing low, that's bearish. Breaks above the 50-day, that's neutral. And that's kind of how I think of these rotating. That's been a helpful way of just summarizing what I'm seeing with the advanced decline lines. I think, as I mentioned earlier, what I would be looking for, particularly here, now that they're back above the 50-day, do they confirm a breakout in price of the S&P and the NASDAQ? Are those breakouts confirmed by improving breadth? And it's, again, not like the market can't go higher with the Magnificent Seven doing the lion's share of the gains. It's happened before, but boy, I would feel much more confident about the sustainability of further gains beyond what we've seen if breadth indicators like this followed suit and broke higher as well. Thank you guys so much for watching. As always, I very much appreciate it. I appreciate those of you watching live and asking questions. I appreciate those of you watching later on our YouTube channel, putting comments there. Really appreciate the questions that come up because it helps me to think about what areas of the market I want to focus on, what topics I want to dig into a little bit further, and makes for some really fun mailbag episodes. I mentioned the latest episodes of our Market Misbehavior podcast just a couple hours ago, released the latest interview with Nishant Pant. And Nishant is the author of a book called, where is it? It was just on my desk, and I put it to the side because I finished the interview. Oh, man, I'm so sorry, Nishant. Where is that thing? Oh, I put it out here. Hold on. Found it. There we go. Mean reversion trading, using option spreads and technical analysis. Whew. It's out on the bookshelf. I'm embarrassed to show you a picture of that bookshelf, which are all the books that I've either just read or just want to read. They're probably 100 odd books on a bookshelf built for about 20. But that is the nature of what happens when you're trying to learn, as always, and learn new material. So check out that latest episode of the podcast. Great conversation with Nishant. That's it for today. Have a great night, everyone. And remember, it's always a good time to own good charts. Take care, folks.